Hey everyone, it's Alissa Coram here. Now, we had two-time U.S. investing champion Mark Minervini on IBD Live to talk to us about his take on current market conditions and also the various macro data points that he's looking at to inform his trading decisions. Take a look.
Mark, yesterday, we did see the lowest level for the NASDAQ in a couple of years now at this point. So it's looking pretty bleak. As you said, things can turn around quickly, but right now it's definitely looking far from good.
Well, it always looks darkest before dawn, so that's the good news that we have
Got to be cup half full, the optimism.
Yeah, we've got a lot of damage that has occurred in the market. If you go back, just to put it into perspective, and you take a look at the damage in the growth names, you have to go back to last year where this started even before the indexes rolled over. Now that we've got the NASDAQ down over 30%, but you have tons of names, my 50-80 rule that some people have heard of. When you get into a bear market, and particularly when you get secular leaders that to top, a stock like an Amazon and Netflix that has led the market for a long period of time, when you finally put in a top in those secular leaders, they'll fall between 50 and 80%. 50% will go down about 80%, and 80% of them will go down about 50%, and the average will be somewhere in the neighborhood of 70%. We've seen a lot of stocks fall 50 to 80%, and some even much worse. So a lot has been discounted in the growth area. Then we saw pockets of strength in oil and a few names here. Now we have some strength in solar. However, the volatility is still too much for low risk breakout traders. There's just too much volatility right now. We're still trading near the lows, but there's a lot of negative sentiment right now. So there's a lot to talk about. I can go on and on and on. The general market, there's a lot to talk about as far as related to a recession, the economy. The first thing to realize is that a lot of people are pointing out the negative sentiment. You have a lot of bearish sentiment, and that's definitely good. But when you're in a negative interest rate environment, sentiment has to be, when we go back and study sentiment versus the market, when you're in a negative interest rate environment, you need more negative sentiment for a longer period of time than you do when you're in a positive interest rate, a good interest rate environment. So right now we're in that environment where we need the type of numbers that we saw in 08, when we saw in 2003, where you get that, not only that excessive bearish sentiment, but it persists for quite a while. And a lot of people are waiting to see a spike in the VIX, which it may happen, it may not. We may get that capitulation meltdown, or maybe we bottom more quietly. But I think a lot's going to depend upon inflation data coming forward here. Now, again, we've seen a peak in inflation in some areas, where if you go and you take a look at lumber prices, you take a look at copper, you look at apartment rent increases, even Tesla had some declining cost, and Best Buy and Walmart, of course, got hit pretty hard back in May. So home prices, of course, have topped out here, at least temporarily. So there's a lot of data that suggests inflation, and that's why there's a big debate right now whether the Fed should ease off a bit here. A lot of people are calling the Fed to stop raising rates, but I don't think that's not going to happen. So again, until we see the inflation, those numbers start to show up in the actual, the CPI on the back end here, we're probably looking at higher rates. And now the thing is that when you go back into periods like 1994 into 95, the market had taken off right around the time that the Fed paused. So I don't think we need rates to start turning down to get the market to bottom. I think because we've discounted so much and we've had so much damage and sentiment is so negative, that the very first signs of that there's any sign that the Fed might pause rate increases, you're probably going to already take off in the market. So I expect the market to be explosive to the upside on that type of news.
Yeah, well, that would be exciting to see that. I know we're all ready and waiting for that opportunity. So, Mark, there are clearly a lot of indicators and data points that you're looking at to help inform your decision-making process. What would you say is the most important indicator for you? I know previously you've said it's the quality of stocks and whether or not they're working. Can you tell us a little bit more about that?
Yeah, you know, the one thing that has never let me down I've been doing this now for 40 years. This next year coming up will be 40 years. I started in 1983 with my very first trade, which was an Alice Chalmer, which is uh, forklift maker or a lawnmower maker. That was my very first trade in 1983. So it's almost 40 years now I've been doing this. And the one thing that has never let me down are the individual stocks. When the individual stocks are setting up, they're breaking out, they're working, the market is good. When they're not, and we're not seeing stocks, or the stocks are failing and they're not working out from breakout levels, the market is not good for my type of trading. Maybe for a value buyer, it's a different story, but for growth trading, growth stock investing, and from breakouts from bases, that's what I need to see. So we could talk about the numbers. We put everything into perspective as far as the economics are concerned, but the market's a discounting mechanism, and not only does the market indexes discount the economy, but the leading stocks discount even much earlier. So generally what will happen is you'll get the best stocks will make their lows first. They'll be in an uptrend before the market ever even really turns up very much. So right now is when you should be looking for those next leaders, not later. This is the time where you roll. This is the most important time. This is the time I love. I love bear markets because I use stops and I'm in cash. I'm not getting hurt in this bear market. So I'm getting prepared for the next opportunity.
Yeah, exactly. And it seems like the worse things get, the bigger the bounce we might see. What do you think about that?
Well, you know, all bear markets lead to bull markets. So you have big, long, drawn out bear markets. You get big bull markets subsequent to that. And all bull markets, or I should say, bull markets are born out of recessions. So, you know, being worried about data going negative in the economy, yes, in the interim, it certainly could push the market down lower. But ultimately, that's where the bull markets are born out of recessions. So, but if you take a look, the real question here is how deep the recession is going to be, because so, and I'll tell you how you hear some numbers like from Stanley Druckenmiller and some of these guys that we have great respect for, and certainly when they're talking about a big depression or a big bear market, we want to take that seriously. However, how are they getting to this number? How is someone like Stanley Druckenmiller getting to a 25% decline from here? First, let's put it into perspective. If you take a non-recessionary bear market, let's just take the last like 4, 5, 6 non-recessionary bear markets. They range anywhere between 14 or 15% and about 23, 24%. But now if you go to a recessionary bear market, you take the last maybe 4 or 5, 6, you're looking at an average of about 43.5%, the worst being about 57%, and the shortest or the smallest, shallowest being about 27%. So you take where we are right now times 25%, you get 43.4%. Takes you right to the average. So those estimates are assuming that we're going to have a recession. So that's the difference between whether this carries on or not. But now you have to take into the fold and try to figure out, this is the $64,000 question in the stock market. What has it already discounted and how far out is it looking? I think that the market has discounted quite a bit and that we're probably in the 7th inning. And while, we could go lower here and maybe there's 10% more to the downside, I think the next leg down will probably be the last leg. But I always say, watch that last stop, that last step. It could be a doozy, So markets don't crash from the top. They melt down after they've been declining, and that's what could give you that capitulation. But with so many people expecting it, I'm not sure it's even going to happen. We may just, it may be just a slow bleed off here. If you take a look at peak inflation, or if you look at the top 10 worst CPI reactions, because we've recently had some negative reactions to CPI, and we'll see what happens going forward here. At some point, you're going to have a peak CPI report where it'll be the worst if we haven't already seen the worst. But when you get that worst, that peak inflation, if you look at the top 10 worst CPI reports going back to the 1970s, the worst reaction was about 17%. The smallest reaction was 5.6%. But when you look forward 1 month, 3 months, 6 months, all the returns on average are positive, with the worst being in 1 month down about 14, actually 1 to 3 months, about 14%. You go up 6 months, you're down about 8%. As you go out further from that, over 1 to 6 months, the returns get better and better, and there's a higher chance that you're going to do well. So in the short term, the peak CPI, the bad report, puts weight on the market, but that creates a buying opportunity. If you take a look at going back at the worst reports, when it looks the worst, that's when you're getting very close to a bottom. I like to look at seeing the numbers, the investors' intelligence numbers being at bulls 25%, bears 44% is certainly great. That's a good sign. But like I said, with interest rate environment negative, you need those really bearish numbers, and they need to persist. So if you take a look at the 1-year Treasury yield, you'll see that basically it started blasting off right almost to the day that we topped in the market. So I think that is sort of an axe in the market as far as, and we just hit 4.24 yesterday, hitting new highs in the yield. So those are the areas that are going to pick it up first, because what's going to happen is you're starting off with the worries of inflation. And of course, then when inflation rolls over, then the question is, did the Fed tighten too much, and how deep is the recession going to be? And that's what we've already shifted to. Now we're shifting to earnings revisions and so forth. So it's a balancing act. It's a balancing act between inflation and then, softish landing or so forth, which very seldom do they engineer a soft landing. Most likely there'll be a recession, and the market's discounting that. But the yield, looking at the 1 year, I would think that would be the first place that you'd want to see that break down and start seeing the yields. So I like to look at sentiment to get an idea how close we are. It's not only what people are saying. There's two types of ways you can look at sentiment. One is what people are saying. So the newsletter writers, they're writing, they're bearish, they're bullish. But then what are people doing with their money? And that's where I start looking at put volume and things like that. And you can also add in the VIX and so forth, look for the volatility spikes. I'd like to see the put volume. Just recently, when we're flirting with new lows, we're not seeing put volume really move up very much. So it still feels like people are trying to pick a bottom. It still feels like, there's a lot of bottom fishing out there that think that, how much lower can Amazon go? How much lower can Tesla go? And so forth. And that's that type of thinking that you need to just pound it out, where, like they did in 2008, where, those bottom fishers were wiped out. And that's when you get that capitulation. So it still seems like there's some complacency out there for how much damage there's been done. There's still relative complacency, in my opinion.
Mm-hmm. And you bring up a good point, because about how invested people are right now and trying to pick a bottom. You are lightly invested at this time, getting that market feedback. What would be a good index level to watch that would mean more significant exposure for you? Is it seeing the NASDAQ get above the 21-day line in combination with promising buying opportunities, or what would be a good signal for you to start adding exposure?
Well, in 40 years, I've never in my life have ever invested and moved my exposure up because of the index hitting a level. So I don't even look at that. So where the levels are, I'm going to look if stocks are setting up and coming out of bases. And if I were to add any index analysis, I would look for follow-through days and look for a lack of distribution. So if you take a look, so again, we'll put some of these things into perspective. September is the weakest month. So between the 6th of September and the 25th of September is the weakest month of the year. Well, we certainly felt that this last month in September. So if you look at cycle work, you take a look at the longer term cycle work, you look at the presidential cycle. We should bottom. It says we would bottom in October, and then there's a very strong upside bias going into the mid part of the year, or certainly into the end of the year. I think that's going to be delayed a little bit. I don't think that we're going to get, and this also is a precedent that I've been using, is 1962. I always like to take the market, try to see what type of markets we've seen in the past and look for precedents. I thought that we would start off bottoming like 1990. That's exactly what's happened so far. But then my opinion was that we would morph into a 62 type bottom. And then depending on inflation and rates, that would make the decision if we played it out more like 62, where we come up off the lows in October and take off, or if we go more into more of a 1970s where that test of lows fails and we go lower. I think we're going to fall somewhere in between there, where maybe by January we can get a better market. We're going into, the early part of next year.
It's always great to have Mark on the show, and I just want to emphasize that he was saying even though there's a lot of this information out there that can help inform our trading decisions, at the end of the day, it comes down to that price and volume action. So we'll be keeping an eye out for that. If you want more videos like this, make sure you subscribe to my channel so you don't miss a thing, and I will see you next time.